In week 2, we talk about the mortgage lending process. So you have a very, very complete set of slides that are given to us by the book publisher. It really contains a lot of the same information that you have in the book. It kind of goes into depth here, so I'm not going to go through each of the slides. It would take way too long. There are 80 slides. But we're going to go through some of the beginning slides and just talk a little bit about the process. Okay, so the mortgage professional functions include some of these things. For those of us in the real estate business, it's good to have an understanding of what the mortgage professional functions are and how some of them might vary depending on a person's role in the mortgage process. So, but if you are becoming a mortgage professional, a mortgage loan officer, or MLO, as they're often referred to, then it's still good to have a complete understanding of all the different levels of the people who do these kinds of things in the mortgage process. So underwriting evaluates the risk, and they decide whether to make a new loan, and they'll also decide the terms of a loan. The funding source does the underwriting, but really one of the most important things is that the underwriters do everything they can to try and reduce or eliminate the riskiness of loaning to any particular individual or group. The underwriting department evaluates income, credit scores, and history. They look at the appraisals, they look at a person's job history, they look at the collateral, etc. So one of the frustrating things as a real estate agent is when the loan is almost approved, but underwriting makes additional requests of the borrowers. You can pretty much bet that this is going to happen on a regular basis. It's very frustrating to buyers too, because they think that they've given everything they needed to give to the loan officer, and the loan officer feels that they've presented a complete package. But when underwriting gets a hold of it, they typically will inspect and ask for more things. They want documentation of different things. They might ask for a complete copy of a divorce decree to make sure that somebody is being honest in what they've said on their forms. They might ask for a certified copy of a person's tax return. They sometimes require letters from the employer. So, there are just a lot of different requirements. Underwriting is the place where the risk is eliminated as much as possible. And then the servicing is done pretty much after the closing. So they will continue to maintain the loan, and the lender or the servicing company will take care of the servicing, meaning they will collect the payments, they will keep track of the current balance, and they will remind people if they've forgotten to make a payment or if an address changes. The servicing department is the one that handles all of that. If you need a mortgage payoff statement because you're selling your home, that's who is the functionality that takes care of that for the owner of the home. So the process of getting a loan has a few different steps. Usually it begins with a loan inquiry. So before the person makes a decision to apply, the mortgage loan officer must provide the APR for interest rate inquiries. So before the application is made, someone would talk to a loan officer and ask different questions about what the interest rate is going to be and how they're going to repay this loan. So the mortgage loan officer has to provide these types of information. Then there's a pre-qualification that's usually done before filing the actual loan request application, because the application is very lengthy and it involves an awful lot of documentation. The pre-qualification is a very simple thing. Real estate officers or real estate agents usually ask for people to make sure that they provide some kind of a pre-qualification letter that shows that they are pre-qualified by a lender in order to buy a property. And the reason they do this is because they want to know, can this person probably get a mortgage? There's no guarantee with it. It really doesn't state that that bank, that mortgage loan officer will provide loans or a loan to the person who wants to buy a property, but it's better than nothing. And the pre-qualification letter examines what types of income the people state that they have, and also what kinds of debt that the people state that they have. And it sort of looks at their job history, and from that, the mortgage loan officer can say, yes, I believe that this person will probably be able to acquire a mortgage loan in the amount of X amount of dollars, just given that this is what they've told me. So none of that is verified during the pre-qualification process. During the pre-approval lender, the lender states that the person can or cannot receive financing and for what amount. So a pre-approval is a little more involved, but it still does not involve a completed application. So these are the traditional steps. First, consulting with the mortgage loan originator, or several. The buyer who is looking for a possible mortgage can talk with several different lenders at the same time to find out who they would like to work with. Then they will complete a loan application. Most people would not want to complete a loan application with 3 or 4 different possible lenders. So by the time they get to this point, they've usually settled on which mortgage loan officer they plan to work with. And then after they've submitted it, then it becomes a processing loan application. So that means the verification is all coming in. The mortgage loan officer is gathering all of that information that they need to submit it to underwriting. And then when it's in underwriting, that's when the borrower and the property are being analyzed. By property, they usually mean they will order an appraisal. And appraisals cost money. They can cost $400 to $500 for a simple home purchase. So usually the money is not spent until they get pretty far along in the process, and all of the documentation to apply for that loan is in the process. People are gathering their information, submitting it. When the individual is consulting with a mortgage loan officer, these are just some of the ideas that a mortgage loan officer would want to keep in mind. That they want to maintain a professional attitude and always inform people, but don't interject their personal judgments about the financial status of the person making an application. They have to maintain privacy. And so a lot of real estate agents like to get in touch with the mortgage loan officer and say, how's it going? How are the people progressing on their application? The mortgage loan officer typically will not give too much information, but will just say we have nearly everything we need, or we're still waiting for a few different documents. These are some of the things that the mortgage loan officer will provide when they start talking with a person who's applying for a mortgage. The interest rate. Now, the interest rates change daily, and so those amounts can go up and down. So the lender usually will give what the daily rate is at that moment, and they don't typically have any kind of crystal ball to say whether it's going to go up or whether it's going to go down, any more so than any of the rest of us who pay attention to financial markets. They might talk about the basis points, and that is a discussion that the mortgage loan officer might want to have, but they could also talk about the par rate without points or discounts that the lenders offer only to mortgage brokers. They would talk about a rate lock. And if you're making an application on a loan, sometimes people decide to lock in a good rate. If they think that the rate is going to perhaps potentially go up, then they would want to get a lock on the rate. That may cost some money to create that lock, and the mortgage loan officer will provide that, but only typically for a certain period of time. So what that means is if you lock too early, that rate may become unavailable if the closing doesn't happen within a specified period of time. So maybe within 30 days from when the rate is locked, the borrower is not ready to close on that loan, and in that case, they wouldn't have that locked rate anymore. So the rate could be higher or it could be lower. The float just means that the borrower is choosing to not lock in the interest rate. And I think sometimes people don't know, or they're not made aware of the fact that they can decide that themselves. They can decide when to lock the rate. If they think that the rates might go up, they might want to lock right away, but sometimes they think the rates might go down, and so maybe they want to wait a little bit before they lock that rate. The mortgage loan officer should also talk to the borrower about fees. What kinds of fees are there going to be, and when will they be due? The lender's return, the total amount the lender can make from a loan in relation to the amount invested. That's something that has become a requirement since the financial crisis. The lender is required to state that total amount of the lender's return. Origination fees. What are the loan origination fees? The mortgage loan officer must disclose those kinds of things. And they talk about the administrative costs of making and processing the loan. So it's not only the income that the mortgage loan officer is going to make, but it also includes costs for the underwriting and costs for the paperwork that needs to be filled out. Sometimes people will pay points to have a lower interest rate, and every point is 1% of the loan amount, and the borrower can use these discount points to buy down the interest rate. The yield spread premium that will lower the upfront cash expense for higher monthly payments, and that's something that the mortgage loan officer can discuss. There are two qualifying standards. So the housing expense ratio is a consideration that is taken into mind, how much it's going to cost for the expenses of that house, and then the total debt to income ratio. The borrower must generally qualify under both ratios. So the mortgage loan officer will ask a lot of questions and calculate what those ratios are. And those are the ratios that are used to determine basic general availability of that mortgage to that borrower. PITI stands for principal, interest, taxes, and insurance. And they also have to include any homeowner association fees that might be included. The housing expense ratio calculates the total housing expense divided by the gross monthly income. So whatever the total housing expense is, so think of that PITI, the principal, interest, taxes, and principal, interest, taxes, and insurance. And then consider what those total expenses are, also adding in if there's any homeowners association expenses. Divide that by the monthly gross income, and that gives you the expense, the housing expense ratio. And then once they calculate that, they decide if that is higher or lower than 28%. And if it exceeds 28%, then it's not going to be a conventional loan, then they have to go to a different type of loan. Then the PowerPoint and the book will go through some in-depth calculations so that you can practice doing that. And then they also talk about the total debt to income ratio. That's a very important ratio. Think about it this way: when you see the word to, debt to income, think of that to as a dividing sign. So it's the debt divided by the income, and that's the debt to income ratio. And that amount is not to exceed 36% for conventional loans. Now remember, they said that the calculations will be important, and the borrower must qualify under both of those. So that's the extent of what we're going to cover here in this discussion, and we will follow up in our discussions, and I will see you next week.